Paul, what is your approach to rising inflation in your portfolio management? And how do you see inflation affecting income over the next 5 years?
Well, in terms of inflation, there's obviously a huge question over where we go to from here. Headline and core rates have risen very markedly. There's signs of wage pressures building, more widespread pressure on inflation. That may well persist after some of these short-term bottlenecks, supply chain issues have been alleviated. But my view is that inflationary pressures will prove to be more transitory than we and others, I think, had initially hoped. But you need to put that in context. Inflation will still remain low by historic standards, but certainly higher, I think, than where we were pre-pandemic. And that means that liquidity and interest rates liquidity will be tightened, rates will rise next year. And equities in general terms should provide some protection against inflation because companies can, in many instances, pass on price rises in their inputs to consumers in many cases. And that's especially true when inflation rises are relatively modest, as I expect. Within the market, certain areas like commodities, financials may perform better in an environment of good growth and rising rates. And we've tilted our allocation towards those areas by allocating more capital to those and higher yielding stocks and value in general. And we've leveled up exposure between growth and value. So we reduced exposure to some of the more expensive areas of the market, which had largely led the way in recent years. They may be a bit vulnerable to rising interest rates, and with more growth globally, that premium valuation may erode. I do expect that not only earnings will recover at a decent double-digit rate in 2022, but dividends will also continue to recover relatively strongly for the trust. We've got a 50-year track record of raising dividends year in, year out, and it clearly remains the intention of the board to extend that record further from here. And I think it'll take a few years, frankly, to get back to a position of having a covered dividend on the trust. But the gap I expect to narrow, and we've got substantial revenue reserves which can dip into to maintain our record, not only of paying, but raising dividends for shareholders.
I absolutely agree, Paul. I mean, obviously, investment companies have a special advantage when it comes to paying income. And we have 18 companies that have increased their dividend every year for over 20 years, and 6 that have over 50-year track record, and F&C Investment Trust is one of them. Gervais, what are the specific advantages in investing in the UK over other developed markets, such as the US, for example?
What's interesting about the UK market, it clearly has underperformed over recent years. But of course, in a way, part of that performance is due to the different heritage. We have a heritage, really, of having companies maybe slightly growing, but they generate surplus cash. And in generating surplus cash, they then either pay dividends or reinvest in acquisitions and other features of growth. So actually, what could happen is we could see a rebalancing of portfolios away from strategies which have performed so well over recent years, these with sort of very rapid growth prospects, perhaps absorbing cash, perhaps like some of the US stock markets, but others as well in the world, perhaps including companies which are less volatile, what's called low beta. And in that regard, they don't tend to zig and zag so much, but they tend to do much more resiliently at times of uncertainty. They've got surplus cash, they don't go bust so easily. And if there are companies which do go into insolvency, then of course they're businesses which can be acquired and hopefully retain that employment, but most particularly make an enhanced cash return on that. The UK has actually had a history of outperforming during more difficult times. Back in the 70s and the early 80s, when a lot of companies went bust, actually the UK was one of the best performing stock markets, way better than the US stock market. So I think there's plenty to look forward to in the UK. The second feature is just to touch on is there's a wide range of market capitalizations. There's some main and mid caps, there's some small micro caps. Again, smallness, I think, has the advantage when things are uncertain. They're nimble, they're able to acquire assets from a receiver and make enhanced returns. I think the UK could be well positioned to do something very different from most other stock markets in the world.
Well, let's hope you're right. Lee, how do you expect sustainable investing to look in 10 years? Got the huge appeal of ESG investing recently. Are all funds going to become ESG focused?
I really hope so. And I think more and more funds will incorporate ESG into that process and think about sustainability issues in their investing. And I think that is a responsibility of the asset management industry going forward, to make sure that financial capital can be used productively for society broadly. There will be different ways of sustainable investing. There'll be engagement, there'll be exclusion-based strategy, and there'll be a positive approach like what we're trying to do with Keystone. And the right approach will be depending on the right client and the right fund manager. For us at Baillie Gifford, we think our competitive advantage is being able to invest long-term and look for genuine disruptive companies that are coming up with exciting innovations. So on that front, we are really excited to leverage on Keystone, on the closed-ended structure of investment trust to allow us to invest in private companies, provide primary capital directly towards businesses to help them scale innovation that will be for a better future.